following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Good morning, everyone. Happy full moon. This happens to be a strawberry moon today. And the reason that's called that is the ancients thought it was a strawberry color as it was going into the summer solstice, which is also going to start today when we start the longest day of the year. Okay, let's move on to the markets. Of course, as you're all aware, there was another poll taken in Britain over the weekend, and guess what? They're going to stay, and you can see what's happened to the markets. Whoever put that poll out, I hope he went long Friday, but it was certainly an interesting poll, but it said that they're going to be. Remember, these things that can go up 300 points, like we've had in the British pound so far today, they can go down 300 points. So just keep that in mind. Don't get too overly enthusiastic either one way or the other. The chart that I've posted in here today is the 4-hour chart of the British pound that goes back several months. And what we've done now is we've completed that third top, as you can see, by the cycles. That's due to come in today. Now, we did take out the June high at 146.73. The old high had been 146.68, so it took it out by about 5 pips. We sold off very, very slightly from that area, but the market's going to be digesting this 160-point move in the Dow and 28 points in the S&P early this morning to see how it's going to act. But we did have a beautiful Gartley pattern in the S&P on Friday down at that 2055 level that we pointed out. It did go down there, held it twice, and then it closed, quite a bit above it, maybe 5 or 6 points above it. And then last night we started to gap, and that's the end of that tune. So we'll see what the next one is going to be. This is a really big date, folks, as far as the astrology stuff comes in. Not just because of the full moon and the summer solstice. There's other things that are there. That was pointed out by our good friend Norm Winsky from Astro Trend last week. One of my biggest surprises, and I'm surprised all the time, is what's happening in the grain markets this morning, because we have this giant high pressure center set over the Midwest that is keeping any type of rain away from the crops. And that usually would have meant, back in the old days, that would have usually meant a really strong opening today in the grains, but we're not seeing that. So maybe there's going to be some, going to be seeing some type of a really nice spot to go long here if we get them down a little bit lower, because this is just the beginning of the growing season. This is why they call it the summer solstice. Okay, all right. Someone asked a question. The first question we've had today comes from our gold bugs. And, well, I don't know if they're bugs or not, but we'll call them gold aficionados. I want to bring this to your attention because we have the potential here for having the second ABCD correction in the last month. And that last one we had was a very, very shallow one. This would be a really good one if we get there. And I think there's a possibility of doing it, because last night gold was down $19. We closed at 1301 and it opened down at 1280 and change. I think 1281. It was down about $20. Rallied a little bit, and then it's been hanging around this 1280 something level. But this would tell us that if we could get this thing down around the 1255 level, which was the old high of the breakout, that would tell us that this would be a pretty good spot, in the gold market to take a look at it. But this is what happened Friday. You see, we had that the $40 break, and then we had this perfect 61% retracement back right on the close at 1302, and now we've sold off quite a bit, but it's still real early in the game in the gold market. This is a big bull market, folks, that's going on in the gold market, and I think you've got to pay a lot of attention to it. I don't know how much this Brexit is going to mean to everything. All I know is the volatility should start to increase a great deal just because of these cycles that we have coming in. These are monsters, folks. We've got one here on the 20th, and then we've got one of the biggest ever coming in on the 28th, 29th, and 30th, the end of the month. We have one of the highest spots for cycles that we're going to see in some time. So we'll watch that, quite closely. Whether it's going to be related to the Brexit or not, I frankly don't know. I think it'll be like the Greek thing. They're going to talk about it till we're so tired of it. It'll be like the election stuff. Then it'll happen, and then we'll move on to the next thing, just like, we ordinarily do, with everything else. So that's what I'm watching in the gold. Silver is the same thing. We should have some pretty good support in silver at $16.90 per ounce if we get down to that level. And of course, I mentioned $12.55. That's $28 from where we are right now in August gold, trading at the $12.83 and change level. Now, we have another market that's been in a downtrend for a while. It's having a really good rally here for the last 3 days, and that is the crude oil market. The crude oil market's going to run in to a 61% retracement here in the August crude at about the 49. Let's just give you the right price here, $49.50 level, which is about 40 cents from where we are right now. It's basically been a straight up move of $4, and that's when we came down 6, rallied up 4, so that takes us right to the 61% retracement at that $49.50 level. If that's where you would like to get short, your risk there would have to be above the 786, which would be $1 a barrel higher at 50. 56 or 50.60, something like that. And if we should get above $52 a barrel, that was the big number that we looked at here in the crude, 51.66, I think is what it was. But if we get above that level, that would signal the same type of move that we had in gold when it broke out above the 1288 area on its way to 1319. So that's a key spot to watch in the gold market, in the crude oil market, is that 49.50 level. I'm going to nibble at it there because I believe that we are in the midst of a bear market rally here over the last few days, and with the emotionalism of the full moon that we're going to have in all these markets, I think we'll have a pretty good shot at looking at something. By the way, someone's asked me a question about these polls that they have in London. They're just like they're, I would guess, and I think this is a pretty good guess, they're just like our polls that we have for our politics here in the United States. I would not want that job, and they're not going to give it to me, so I don't have to worry about that. But that's one of the things that we'll be watching. Okay, when we get back, I want to go into the S&P and then also the euro. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to take a look here now at the S&P. As you can see, the pullback that we had here on Friday, that 2055 was spot on, 61% retracement. The market acted pretty nicely. It closed 4, 5, 6 points above it. And then, of course, we gapped up 15 or 18 points last night, right after the market opened due to the Brexit. By that time, we had seen the DAX had gapped up almost 300 points. That also had come off of a perfect Gartley pattern in the DAX that we showed in here on Friday. We had the same thing happening with the FTSE. It also did exactly the same thing, making a 61% retracement on a Gartley buy signal on Friday. And of course, with this full moon coming in today, anything could happen, and it usually does. So anyway, this is what we're looking at now in the S&P. We should have some pretty good resistance at the 2089 level. Just remember the old market adage that any market that can give you 30 points can take 30 points away from you. Just keep that in mind. But we do have a really strong number up here. The problem is we have this huge gap that will be filled. I mean, you're not going to find a gap like this. It's not going to be filled on the S&P. How long it's going to take to fill it, is another question. But that's neither here nor there. Now, if you want to see the same pattern that we had in the S&P, if you'll take a quick look here, we're going to switch over to the euro for just a second, and you'll take a look at what the euro did last night. And here again, you can see that very first long green bar from last night. I did this a couple hours after the market had opened on Sunday to get it ready, because I was assuming that we were going to get up to that 786 level and the ABCD, and it did. The high on the overnight market was 113.72, and now we're trading around 113.30, so it's backed off a little bit. from that level. But this is just a really another rally, whether it's based on this exit poll or whatever it is they're talking about. I'm not sure, but there should be some resistance that has happened so far in the euro. Not a lot, but it's enough to tell you that the numbers are still working, and that's the real key, to be watching here, because we've got the euro, is trading at 113.46 right now. So it's backed off a good 70 pips. Oh, that's not true. Let's figure it out. 65 pips, off the high. So that's quite a bit. That's equivalent to 14 points in the S&P. So those are pretty big swings that we're seeing here in the euro. Nothing like what we're having in the pound. The pound moved over $2,000 from Friday's close, up 300 points, 300 pips. And it also has reached a major area as it took out the June highs at 146.73. We're trading at 146.48 presently. So those are the ones, that from the currency standpoint that I'm looking at. The other ones are not, I don't have hardly any interest until we get this Brexit thing out of the way. This is going to be what the markets are going to focus on, just like we did with the Greek thing. And they're going to feed us all of the stuff that they always feed us to see if it's going to be right or not. But we'll just let them feed it to us, and we'll see how much we can digest. Okay, let's move on to the next one. Boys and girls, let me give you my idea of, I don't know what LEQ is, Mr. P. You're going to have to tell me what LEQ is. I don't know. So I'm not sure what that is. If it's a stock, I have no chance. But let me go into a little, I've got a few minutes here, but it's going to take me longer to do this. I'm going to put this chart up here of the 30-year bond, and we'll just take a look. Oh, come on, sports fans, where are you? There we go. Hold on here. Oh, live cattle. Oh, gosh, I forgot that's electronic live cattle. I'll have to take a look a little bit later. I haven't really been looking. I know they've been going down, but I don't know if it's due to the hot weather or not. But let's look at something that is really important, folks. This is a chart going back to August of 1981. If you notice the secondary bottom there, which was August of 1982, that was August the 9th. That's when we had a huge 5-planet conjunction area occurring that was suggesting that was going to be the bottom in the stock market, which it was. And it was also the turn in the interest rate markets from the old 12 or 13% T-bill rates to, where we are to this date, where we're at zero level. But if you look at this chart, this is a continuous 30-year bond contract. You'll notice the 3-drive pattern that you can see here over the last 6 years. That's 3 years each from high to high. It's just absolutely a perfect setup when we got to that 171 level on last Thursday. That completed that pattern. Folks, in 1991, I started a thing called the Trade of the Year. I did, what I thought was going to be the best trade of the year. And I did that for about 13 years. In the first 10 years, I hit 10 home runs. I mean, I got really lucky basically looking at this 3-drive pattern or a butterfly pattern. That's what I was looking at. And, I bought crude oil at 11 and change a barrel. I bought gold at, 275, soybeans at 350, some really big moves. But this has the potential to not be the trade of the year. I'm not doing a trade of the year. I'm not doing a trade of any kind. I'm just showing you this pattern because it's a monster. And I think this is going to be the biggest winner of the next decade. So if I had to do it, I'd call it the trade of the decade, because you just don't see stuff that lines up like this so easily. And you see it all across the board. If you take a look at the Dow Jones Utilities, which are definitely tied to the interest rates, you'll notice that you'll see that we have this same 3-drive pattern. Now, remember, you can see the harmony here. This goes back to 1942, folks, this Dow Jones Utilities chart. This is from our good friend Jim Bartolioni. But look at the similarities in those moves. I mean, you can't make that stuff up. And people that are doing this kind of stuff, they don't use technical analysis like we do. Maybe we're using it wrong, but that's what it looks like anyway. I mean, it's just perfect. You got high to high, perfect ABCD structure. Not only that, if you look at the right-hand side on the lower section there, you'll notice that relative strength is decreasing, which is also a real negative sign. If you go back to the drive 2, and you'll go down and see what relative strength was doing at that time, look what was happening. And if you go to drive 1, what relative strength was happening at that time. So this is what Bart's looking at, is he's watching this divergence in relative strength at the same time when you have this absolutely symmetrical ABCD pattern in the utilities that is just, really, it's really quite amazing. And people are buying the utilities because they're interested on the return on their money, not on the return of your money. And I'm going to be going over what I see as potential trading opportunity in that in just a little bit, because we're going to have a break here really soon. But I wanted to show you what the inverse chart for the utilities. In other words, this is equivalent to the, hold on just a second here. This is equivalent to the TBT in the utilities. This is the inverted, it's ultra short utilities. We'll cover this at the break. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I've posted 2 things. I posted the chart of the SDP which is the ultra short utility index. And as you can see, back in 2008, it hit $1,700 a share, and now it's trading at 33. If you got the memo about selling at $1,700 a share, this would be the time you'd want to be covering that short. And if you believe that, I still have 2 shares of the Brooklyn Bridge available. I didn't do any of that. Of course, I was short stocks during that time, but not the utilities. I'm trying to explain to you why I think these interest rates are getting ready to go higher. And why, I don't know. All I'm saying is the pattern is there, but it's there everywhere. I mean, it's across all forms of interest rate stuff. So it's really interesting. Now, the next chart someone's asked me to put up is the German DAX that I was talking about, the Gartley pattern that happened there on Friday, down at that 94.90 level. We're now trading 450 points higher. We're up at 99 and change now in the DAX, also leaving a huge gap. This pattern is exactly like the one we saw in the FTSE. Doing the same thing, and in pretty much same thing in the S&P, but the S&P was based on a smaller pattern that was based on the hourly chart. So that's the one that we were watching. I wanted to get into this utility thing. What I did was I went and took that SDP, that ultra short Dow utility, and I said, well, let's take a look at this on a daily basis to see what we've got going on here. And as you can see here, this is the SDP ultra short Dow utilities, and over the last 3 months, we have a perfect butterfly pattern. We were at the 1.618 level, and the market rallied all this past week, which was ultra short when we're making new highs. This thing should have been going down. This is very bullish price action. There's one really simple explanation for this, folks, and it shocked me when I looked at it, is there is no volume in this puppy. There was 300 shares on this thing on Friday. I mean, there's nobody trading this thing. And at the top, when it was at the 1700 area, you had over 30,000. But now there's just nobody in it. So you really can't do that. So the next step, I said, all right, what would be equivalent to be looking at the ultra short SDP? And so I assumed, well, it must be related to the Treasury bond. So what I did was I took the long-term weekly view, and you'll see that this is what's happened since 2012. You'll see how the SDP, which is the ultra short utility index, has gone down to where it is right now. And that's the spot where it should hold, somewhere around 33. And then you can see the blue line, which is the Treasury bond ETF TBT. In other words, the ultra short Treasury bond ETF. So this is the one that we're sort of watching here if we're getting ready to see this thing move. The safest trade, you don't have to try to pick a bottom in here. I think you're going to get a rally back. This market's been so bullish for so long. There's going to be some really good retracement levels, I would think. So we gapped down a full handle today in the bonds. We went all the way down to, somebody wants to see the utility one. Hold on just a second here. I'll repost these one at a time. I guess they're not hitting. I don't know why that is. Well, let's just do let's just do it this way. Well, shucks. Yeah, the good old computers. Okay, that's the butterfly pattern. That's the 3 drive pattern that we're seeing in the ultra short utility, but that has no what we call volume. I mean, nothing. I mean, it's just terrible. But if you wanted to do something that has a high correlation with something like that, all you would have to do would be to look at the TBT, and you can see that the correlation is extremely high, and the TBT is one of the bigger ETFs that you're able to look at, to see that it's working. But this is mother, God, and country, folks. If you like pattern recognition, pay attention to this puppy. You don't see them like this very often. You just really don't. This is really big time stuff. If we look at the long-term bonds, just quickly look at some of these others that I went through all of these. In fact, the notes never even made new highs. They say that they did, but the actual futures did not. We did make a new high by about 6 pips on a weekly basis. Those are ticks, 6 ticks at the 171 and change level. The old one was 170.28. We closed down at 169.15 on Friday, and we're trading below 168 right now. So we backed off quite a bit in that one too. But these are really, really long-term patterns. And remember, this is pattern recognition stuff, folks. That's all it is. Never profess it to be any more than what it is, but that's what it is. So that's what it shall be, and what it shall be is what it will be, and what it will be is what it will be. Okay, this is the Treasury Note weekly chart going back to 2009. You'll notice that the head and shoulders pattern that we had here, that has not been violated. We did not take out those highs in the futures market from 2013. That was above the 132 and change level. We did get to 132.16 in the notes, but we did not take that out, and that you can see what's going to happen. Folks, if this is the fact that we are looking at higher interest rates, and if we look at our mortgage market, we're having a rough time selling houses. We haven't sold a house in our neighborhood in Tucson in almost a year. There's only 4 or 5 places out of 80 that are for sale, but they're just not moving. Even when they reduce the price, they're not moving. So there's something not right. So we'll have to watch that a little bit closer. But a small increase of 100 pips will raise someone's mortgage rate by, a mortgage payment by quite a bit. And that's what you don't want during a time when you're looking at a housing market that's having some problem. The same thing is happening in the Phoenix and Scottsdale area. We have some friends in the real estate business there, and they're really complaining that the business is just, it doesn't exist. It's just not slow. It's just not happening. So I don't know if it's just this time of the year, but usually it isn't. This is, people are used to hot weather up in this way, but, we'll wait and see. Okay, that's another one that I want to look at. Just pay attention to these bonds and stuff. We'll be able to see if this is going to be a major turn down. And if it is, it'll be a big surprise. And that is the kind of market that can really pay big dividends when you catch it real early. And remember, we're only 4 points off the highs in the bonds. So we'll be able to see if that's going to be the case. I handled the bonds absolutely horrible up at that top. I'd sold them 169.28. They broke down about 1.5 points, and I said, "Oh boy, that's the high. It's never going to go higher than that." So I put my stop at break even, and the next day, with Janet Yellen speaking, it went up and took out my stop at break even, and I'd even had some TBT that I ended up losing about 30 cents on. And now I'm looking at myself in the mirror and I'm saying, "Mirror, mirror on the wall, you the dumbest of them all." I should have waited one more day, but given the environment, I just didn't want to, look too foolish. And so I decided to wait and go another day. So my plan is to get the thing on the way back on a rally. That's what I'll be looking at. But there's other things that we got to be watching, folks, that are very important too. We'll be right back.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, swim lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, folks, we're now reaching that level in the S&P at 2089.50. We posted that a little early. We'll post it again, but I wanted to show you the chart of the 30-year German bond that went negative last Thursday at that 1.618 expansion. As you can see, there's been 2 strong down days now in the Bund. That means interest rates have started higher. Now, maybe it turns and goes back up and makes a new high. That's certainly possible, but that pattern is now complete. That's also the same type of pattern that we're looking at on our long-term bonds and also our notes and, of course, our utility index. All of those are telling us that that's what we're looking at this particular level in here. So watch it very closely. How that will affect the gold market, I do not know. Several people have asked me that question. I'm not sure. All I know is that the gold still looks bullish to me. We had that $40 rally. We had another $30 rally, another $30 drop. But if we could get it down to $12.55, that would be a really nice ABCD pattern on the gold. And I think you'd have to take a look at that because Gartley said in his book, Profits in the Stock Market from 1937, anytime you see an ABCD pattern in a bull market, you buy it. And if you see an ABCD pattern in a bear market, you sell it. And that's been relatively, pretty good information to go by. Copper has not really done a lot. It's in this trading range. I still think copper is headed lower. But, you're going to get some of these emotional things that are going on. So I don't really, I just don't have the interest in copper. I'm basically looking at the foreign exchange markets because they're easier. When you look at the Australian dollar, the Canadian dollar, the euro, the pound, the yen, and the Swiss franc, you really get some really nice patterns that are much easier to trade. And they're not influenced as much by, some of the news. And these markets are so big that no one can manipulate them, not even central banks. So they're the better ones to trade. Wheat is also, I didn't post any of those. I'm going to do that tomorrow. I'm going to try to do the main thing on the grains later on, but wheat is still in a downtrend. The reason why I didn't do the grains this week, this is not what's important, folks, because we got to get this Brexit thing out of the way. I don't think it means a lot. but the market thinks that it means a lot. So you have to pay attention to what the market is doing. So, that's the key to this. And we're going to have some, we're just starting the growing season, folks. This is the solstice today. So, this stuff is going to have some really big, scary stuff, I think, happening. When you have, these markets that have moved as much as they've moved, that tells us that there are people out there that are a little concerned about what the crop is going to do. So the slightest, movement to the upside will make the grains look okay. But right now, I think you've got to focus on the fact that what you're looking at here in these in this currency and the stock market and the bond market, which is many, many times bigger than the stock market. And if we looked at our market for high-grade bonds, the junk bonds, high-grade bonds, low-grade bonds, i.e. junk bonds, that market even looks a lot worse, but there's really not a way you can participate in it unless you sell the bond outright that you're looking for, which the ETF, HYG, and JNK, they're just not capable of doing it. So that's the only way you can look at it. But anyway, that's what we're watching in the grains. That we're having some pretty good movements. Now we've hit this level. I'll post this again because someone just asked me about it. This is the level that we're looking at here in the S&P at that 2089 level. 2089.50. I think our high's been 2089.75 so far. So that should be some pretty stiff resistance in there, but 3 or 4 points above that, it's probably wrong. This is one of those times you don't even have to risk that much because it's got to hold this 2090 level. Otherwise, it's in severe distress. So that's the main thing. Someone's asked where would I look to short the September bonds if we were to get the movement in the bonds? If we could get the bonds about 1.5 points higher, 169.26 or so, I would be willing to step in on the short side in the Treasury bonds at that point, risking about 1 point because of the fact that this is something that's really looking at. Now, if it's really bearish, we left a gap down today at the 382 at the 169 level, 169.01. And should we just get back to 169.01, which is 1 point from where it is right now, and then turn down, then you're looking at something, really, really negative to the downside. Folks, this pattern in the bonds is probably as good as pattern that we saw in stocks to buy on March the 5th of 2009, when we had all of those big ABCD patterns and butterfly patterns forming at that point when we had the multiple, I think we had 8 cycles due from astro cycles that day on March the 5th. And this market has the potential for that same type of move. This is not just a day trade thing, folks. This is something that could last for, a long, long time. That's the key in this bond market. These patterns are just they're really they permeate all parts of the interest rate structure of our economy, in the utilities, the bonds, the notes, the bund. I mean, all of it is all lining up just perfectly. And you can't make this stuff up. It's just not you're not allowed to do that. But there's not people that do what we do, and that's probably a good thing. But there's not many people that do technical analysis like what we do. So, and sometimes we're totally wrong. But boy, this time it's gosh darn, it's got everything that you could possibly ask for a long-term trade. If you could buy a long-term put on a bond, I'd certainly look at that. I don't know what the cost would be, but if you've got a grandchild that you wanted to maybe buy some books for his nursery school or something, take a look at a long-term bond. I wouldn't go out more than a year, and I'd pick a strike at about 165. I don't know what it'd be going for, but it'd probably be cheap. But we could see something, really dramatic. This would be the big surprise, is if the interest rates started to go higher. Remember that the Federal Reserve is doing this giant experiment, just like Japan is doing, and you saw what happened in Japan. That experiment is certainly failing. Now, Japan is strong today also because of Brexit, but if you look at the Japanese market, on any other way of looking at it, this thing is really, really negative, folks. You talk about a stock market that is under a great deal of pressure, and that is this we're just going up to fill this gap that we left the other day. That's up another 300 or 400 points. you'll see that this is the weekly chart of the Nikkei, and we're trading around 15,800 and something right now, and we left a gap at 16,000. So we could get into that gap area on some type of a Brexit rally, but boy, this longer term chart on this really has some negative, implications here. You wonder where these markets would be if that exit poll had turned out to be negative, that they were going to leave Britain. You'd be looking at some markets that would really be under some severe pressure. That's why when you hear these polls, you have to take them with a grain of salt, no matter what you're looking at. Everybody has their own interpretation of what things are doing, so just be really careful about what you're reading and what you're looking at. Watch the charts, because if there's prices are going down, there's more sellers. If prices are going down, there's more buyers.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we're taking a final look here at what the markets are doing. We're up quite a bit, 26 handles, excuse me, in the S&P 500, up 150 in the Dow, so everything's looking pretty good. By the way, the Dow Jones also made a 61% retracement, much like we did in the S&P, but anything above 2092 would tell us that this thing is going to keep going higher. We have a full moon today that happened at 7 o'clock Eastern time. And we have the summer solstice that starts today, which will be our longest day of the year. This is a very, very important day. But the most important day will be the cluster of days between the 28th, 29th, and 30th. That's in the middle of next week. We'll be looking at something that is going to be really amazing as we come into July 1st. It's going to be very, very important to look at. We are seeing a lot of things on the internet now about a potential crash scenario. You shouldn't look for crashes, just look for trading opportunities. That's basically because the number of times you see a crash, you can put on the head of a pin in boldface type. So don't try to look at that. Try to find the things that fit your trading style and go from there. But if you have a portfolio that is based on interest rates going a lot lower, I would certainly recommend that you take a look at the newsletter that I did this weekend to look at some of these charts, because they are very, very scary as forming a top in lower interest rates, i.e., higher notes and bonds should be going lower. So these are just patterns. That's all they are. But they are patterns, and not many people do what we do. So it's sometimes, you should pay attention to it. I wouldn't be this adamant about it if I didn't think it was that important. So just keep that in mind as you watch it. Also, watch the gold. If you get a breakdown to that 1255 level, I'd be looking at a potential I'd be looking to be a buyer at 1255. You have to risk about $15 at this point because of the fact that it's so volatile. But that's actually the second ABC that we've had since this market bottomed in February. 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.